Financial instruments. In this section, we're going to be diving into the different types of financial instruments you might encounter as a trader, and we might go over in future lessons. I want you to think back to the volume video. We spoke briefly about the derivative market and the contracts as the units that were involved in the derivatives market. Here we're going to be looking deeper into derivatives. But before we understand the different types of derivatives, let's get a basic definition of what a derivative is and why they're used. So let's start off square one. The term derive or derivation, which many of you have probably heard, means to obtain from something else, or it's derived from something else. Derivatives are products that derive their value from something else. Now, what is this something else? Well, this something else is stemming back to something we talked about in lesson 1, the different types of asset classes. Assets can be stocks, bonds, currencies, commodities, cryptocurrencies, interest rates, indices, market indexes, things like the S&P 500 or the Dow Jones Industrial Average. So, if a derivative is its own financial instrument and it's deriving its value from one of these asset classes, we can start to understand what it actually is. Now, things that I just named, stocks, bonds, currencies, commodities, cryptocurrencies, interest rates, indices, these are all underlying assets. You're asking yourself, well, what does underlying asset mean? It's simply the asset that the derivative is getting its value from. This can often be called the spot market or the physical market. I want to take an example like gold. Gold is heavy and expensive. For investors to participate in it, they can use derivatives as a way to get exposure in the gold market. This can be in different types of derivatives like futures and options, which we will get into later on. But for the purpose of this lesson, and just grasping what a derivative is, understand that it's a financial instrument, its own asset class, that its value is dependent on what the underlying asset is. The way they are traded are through contracts, and these contracts are between two or more parties. And the value of the asset, in this case the derivative, or the price, is going to be determined by the changes in price of the underlying asset. Now you probably are a bit confused right now, and that's totally okay, because we're going to take this slow and we're going to figure out what derivatives really are and how we can start to use them. Before we get into that, why do we use derivatives? There's two main reasons I want to go over for the use case of derivatives. Hedging risk. This is a tool. Remember, these are all tools that we're putting in our trading toolbox. Derivative is a tool to limit your risk or losses around uncertainty in future price direction. Think of it almost as an insurance policy. The second would be speculation. This is betting on the direction of the underlying asset. Remember, key to grasp what the underlying asset is. So let's take a market index, the S&P 500. A derivative, in this case, would be a way for us to speculate or bet on the direction of the S&P 500. This is more a profitability-based strategy versus risk mitigation. Risk mitigation, it's a fancy term, but it's thrown around a lot and you might encounter it in your trading career. So simply put, it's just a way of saying, how do I limit my risk or exposure to this asset? Moving on, let's start to look at what types of derivatives we might encounter. Some of you may have heard of these terms, some of you may have not, and that's totally cool. But we want to create an awareness and a sense of familiarity around these types of derivatives in case you come across them in your trading career, and we will be talking about these going forward. Forward gets me right to futures and forwards. Futures, or forwards, are a way for individuals to hedge their risk or speculate on the future price of an asset. So what do we mean by that? Let's take gold for an example. If the price of gold is, for all purposes, $1,200 today, and you think that the price of gold is going up, you can buy a futures contract. That futures contract is a specified price at a specified date. Futures contracts have specific contractual details in it and are traded on a regulated exchange with a clearing party in between the two parties entering into the contract. Forwards are more commonly used in business type incentives where I might be a manufacturer selling to a wholesaler. In this case, if I was a wheat manufacturer selling to someone who makes cereal, my concern is what the price of wheat is going forward. Futures are a way for me to hedge my risk against underlying price fluctuations, whether it be to the downside or an increase. Forwards are the same, except they're not regulated contracts. Moving on to options. Options is a fancy term for insurance policy. Now, options on the surface can be very daunting, but in reality, again, it's just another tool that we have to hedge risk or speculate on the asset. Options require less capital up front and deal specifically with contracts that give an individual the right to buy or sell an asset at a specified date and price. This specified date and price is known as an expiration and strike. Again, we're not going to go into options detail too much, but we want to give you a basic understanding. Swaps. Swaps are a unique financial product. They're basically swapping one asset for the other between two parties, and the swap is going to be cash flows from that particular asset. Now, this gets into some complex scenarios, but common swaps you might hear about in regular financial markets, things like interest rate swaps. As we dive deeper into the cryptocurrency markets and examples that we're using, we're going to be going over swaps. This is a common financial instrument used on a lot of the crypto exchanges today, where traders are looking to use leverage or margin as they put on trades. We will be talking about a particular instrument called the perpetual swap product. Perpetual means that there's no specified date, like a futures contract or an options contract. So it's ongoing. But again, these are topics that we're going to get into later as we dive into things like leverage and perpetual swaps. So, we just wanted to give you a primer on all of the types of derivatives, what a derivative is, the underlying asset class, spot market or physical market, and for you to gain a bit of confidence as we start to talk about these in more detail moving forward.